Can classic statistical theory really work in actual trading? Today we are bringing you an exploratory strategy that directly applies time series analysis to return prediction. This strategy shows how to transform standard econometric models from textbooks into executable trading logic, providing a positive research example for combining theory and practice in quantitative trading. Hello everyone. Welcome to the Inventor Strategy Selection channel. This channel is dedicated to explaining the most classic and cutting-edge strategies in the cryptocurrency field. Have you ever thought about putting the statistical knowledge from textbooks into active practice? This strategy is exactly such an attempt to combine theory and practice. This strategy goes beyond the constraints of traditional technical indicators, directly using the standard framework of modern financial econometrics to build a return prediction model. It uses an AR model to predict the conditional expectation of returns, uses a GARCH model to estimate the conditional variance of prediction errors, then constructs statistical confidence intervals to guide trading decisions, providing a theoretically grounded analytical framework for quantitative trading. This strategy adopts the standard modeling framework of modern financial econometrics to jointly model return series. The strategy is based on a two-step modeling approach. First, it uses an AR autoregressive model to predict the conditional expected value of returns, based on the memory characteristics of financial time series and the stationarity assumption of returns. Second, it uses a GARCH model to model the conditional variance of AR prediction residuals, capturing the time-varying volatility characteristics of prediction errors. The core logic of the strategy is to use the AR model's return prediction as the center line, combined with the conditional standard deviation estimated by the GARCH model to construct dynamic confidence intervals in the return space, then convert them to price space to form trading bands. When actual prices deviate from the statistical prediction interval, we consider it a mean reversion trading opportunity. This design embodies the core idea of joint modeling of conditional expectation and conditional variance in modern financial econometrics, providing a practical statistical theoretical foundation for traditional technical analysis. The parameter design reflects the modeling requirements of modern econometrics and the balanced considerations of practical applications. The AR estimation window is based on the classic trade-off between sample size and estimation accuracy in financial time series analysis. Too small a sample leads to excessive parameter estimation variance, while too large a sample reduces the model's sensitivity to market structure changes. GARCH volatility model parameters control conditional variance calculation. Parameter alpha controls sensitivity to new information shocks. Beta controls volatility persistence, and their sum must be less than 1 to ensure stationarity of the variance process. The standard deviation multiplier parameter directly corresponds to confidence levels in statistics. Setting it to 2.0 roughly corresponds to a 95% confidence interval. Risk control parameters use a fixed proportion design, providing a standardized experimental environment for theoretical verification of the strategy, making it convenient to evaluate the effectiveness of the model itself. RSI filter parameters serve as optional technical analysis supplements, adding a market sentiment judgment dimension to the pure statistical model. This design allows the strategy to add technical analysis confirmation on top of statistical signals, reducing false signals in oscillating markets, reflecting the pragmatic orientation of combining quantitative models with traditional analytical methods. The indicator definition section demonstrates the practical application process of the standard AR-GARCH model. The calculation of log returns adopts the standard practice of financial econometrics, ensuring to some extent the reasonableness of stationarity and normality assumptions of the series. The autocovariance function calculation comes directly from time series analysis theory, accurately calculating the covariance matrix for different lag periods by traversing historical data, providing input for the Yule-Walker equations. The solution of these equations reflects the application of the method of moments in AR models, obtaining optimal autoregressive coefficients through linear algebra operations. The stability test of AR coefficients ensures the model meets convergence conditions, which is a basic requirement in time series modeling. The calculation of return means provides necessary centering parameters for the AR model. The signal generation section implements the core modeling logic of the AR-GARCH framework. First, it predicts future returns through the AR model based on linear combinations of historical returns, reflecting the memory characteristics of financial time series. Then it calculates the prediction residuals of the AR model, which represent random shocks that the model cannot explain, providing theoretical basis for subsequent GARCH modeling. The GARCH model dynamically estimates the conditional variance of prediction errors through a recursive updating mechanism, effectively capturing the typical volatility clustering phenomenon in financial markets. Finally, it converts conditional variance to standard deviation, providing a risk measurement basis for constructing statistical confidence intervals. This section converts statistical modeling results into actual trading signals. First, it constructs dynamic confidence intervals in the return space, embodying the core concept of interval estimation in statistics by adding and subtracting multiples of GARCH standard deviation from R predictions to determine statistical boundaries. Then, through exponential transformation, it converts confidence intervals from return space to price space trading bands, bridging the gap from theoretical models to practical operations. Trading signal generation is based on the statistical arbitrage idea of mean reversion. When actual prices deviate from statistical prediction intervals, we consider it a trading opportunity. The addition of RSI filters adds a technical analysis confirmation dimension to the pure statistical model, helping reduce false signals in oscillating markets. The strategy execution section maintains the simplicity and standardized features required for model validation. The opening logic is based on statistical confidence interval breakouts, immediately establishing positions when prices deviate from theoretical prediction intervals, embodying the core idea of statistical arbitrage. The fixed proportion stop-loss and take-profit mechanism, although lacking dynamism, provides a controllable experimental environment for theoretical validation of the strategy, avoiding interference from complex risk control logic on the model's own effectiveness. The entire execution logic is designed to provide a fair validation attempt for the theoretical model. The visualization design provides intuitive observation tools for AR-GARCH model validation and analysis. The comparison between actual prices and predicted prices can intuitively show the price prediction accuracy of the AR model based on return modeling, which is important for verifying the effectiveness of model assumptions. The drawing of upper and lower bands shows price bands converted from return confidence intervals, helping observers understand how GARCH volatility modeling affects the dynamic adjustment of trading thresholds. Trading signal markers provide a visual record of the strategy's decision-making process, facilitating analysis of signal quality and timing of statistical arbitrage opportunities. This visualization design not only serves actual trading, but more importantly provides necessary observation means for empirical testing of the standard AR-GARCH framework. Although strategies based on return modeling are more rigorous in theoretical framework, they are essentially still simplified implementation models. The use of log returns largely alleviates key problems in modeling. Return series are usually closer to stationarity than price series, significantly reducing the risk of spurious regression caused by non-stationarity. Log transformation also improves the normality assumption of the series, providing a more reasonable statistical foundation for AR and GARCH models. The strategy has natural advantages in mainstream cryptocurrency markets where volatility clustering phenomena are obvious, because GARCH models are designed specifically to capture this typical characteristic of financial markets, and can dynamically adjust risk estimates to adapt to changes in market sentiment. As an initial validation attempt for theoretical learning and model development, this strategy shows beginners the basic implementation ideas of the standard AR-GARCH framework, providing a complete conversion process from theory to code. To enhance the strategy's practicality and execution efficiency, this implementation intentionally simplifies some tedious testing procedures from traditional econometrics, including rigorous statistical selection of AR and GARCH orders, unit root tests, residual diagnostics, and other steps, directly adopting the empirically well-performing AR-GARCH combination. This pragmatic trade-off significantly improves the strategy's operability and computational efficiency while maintaining the integrity of the core theoretical framework. As a simplified model, it may fail when facing structural market changes, extreme event shocks, and other complex situations. Advanced applications need to supplement complete statistical testing procedures and consider introducing regime switching models or time-varying parameter techniques to handle the dynamic characteristics of models in order to build more complete econometric trading systems. This strategy is a good attempt at applying theory to quantitative strategies. In terms of strategy completeness, It forms a standard econometric analysis chain from return calculation to GARCH modeling, follows the modeling standards of modern financial theory, and provides an excellent example for the engineering implementation of academic theory. Although risk management adopts a simplified design, this standardized treatment is more conducive to objective evaluation of the theoretical model's own effectiveness. Adaptability has been substantially improved. Modeling based on returns ensures better statistical properties, and GARCH's dynamic volatility estimation provides theoretical support for market risk changes. Understandability requires a solid econometric background, but this precisely reflects the practical value of academic theory. Innovation lies in completely transforming the standard theoretical framework into executable trading strategies, providing valuable experience for exploring applications of more complex models. Although practicality still has limitations, it has important value as a theoretical verification and teaching tool. More importantly, the biggest advantage of this strategy is that it breaks free from the constraints of academic research. There are no standard answers to pursue, no review experts to please, no need to stick to textbook-style rigid testing procedures. In the actual trading environment, the only criterion for judgment is return performance. This freedom allows us to flexibly adjust and improve models based on market feedback, truly achieving organic integration of theory and practice. This is the best way to apply theoretical knowledge to practice, opening up broad space for theoretical innovation in quantitative trading.